Welcome to TalkTickers, your shortcut to really getting up to speed on the latest earnings calls.
You try your best.
Today we're doing a deep dive into J&J Snack Foods ticker JJSF. This is their fiscal third quarter 2025 call.
Yeah, this one happened on August 5th during market hours, and, well, the market seemed to like what it heard.
Definitely. So we're going to unpack the key numbers, pull out what management was really highlighting, and, figure out what it means for you in the broader consumer staples picture.
And it was quite a call. I mean, what struck me was how JJSF's management showed they can really navigate what's still, let's face it, a tricky consumer environment.
Right.
They put up strong numbers even with consumers being cautious and some, specific weather issues hitting their big summer season. It really says something about the strength of their different brands and products.
That resilience, yeah, that's exactly what jumped out at me too. Let's maybe start with just the highlights, the headline numbers. Because JJSF, they really delivered a strong quarter. Both top and bottom line beat expectations. Like their GAAP earnings per share, that's the standard profit measure, hit $2.26. The consensus was looking for, $1.84. So a big beat.
Yeah, a significant beat. And the adjusted EPS, which, smooths out some of those one-off things, that also came in strong at $2 versus the $1.79 expected.
So strong on the profit side. And revenue.
Revenue was a record. $454.3 million. The street was expecting more like $444 million. That's a 3.3% growth year over year.
Okay, solid growth.
And adjusted EBITDA, kind of a proxy for cash flow, that grew 2% to $72 million. But like you said about profit, the operating income number was maybe the most impressive, up 21% to $60.6 million.
Wow, okay. 21% on operating income when revenue is only up about 3%. That tells a story right there about efficiency, doesn't it?
It really does.
Their gross margin was 33.0%. A little dip from last year, but management said that was mostly about product mix, selling more of certain things, maybe lower margin things.
Right, a mix shift. But overall, like you said, the market took it well. Seems like they accepted the numbers and the outlook.
Yeah. And connecting that to what the CEO, Dan Fachner, said, he pointed to record sales and EBITDA, right? And credited the resilience of our portfolio and disciplined execution.
Exactly. And that's key because lots of consumer companies are, struggling a bit with cautious spending supply chains. JJSF hit records despite those things, plus their own weather issues. And he specifically called out strong theater traffic. Said the Minecraft movie, of all things, helped make up for softness elsewhere.
Gaming and pretzels. Who knew? Okay, so those are the big numbers. But let's dig in a bit. Where did the strength really come from when you look at the different parts of the business? What stood out to you in the segments?
Well, food service was definitely a highlight. Sales up 4.8%.
Yeah.
And within that, pretzels just surged, up 12.8%. And Bavarian pretzels specifically were up 20%. That actually helped boost J&J's overall pretzel market share by 1.3 percentage points. Shows they're really dominant there.
So core stuff and key channels doing well. But I noticed it wasn't all positive, was it? Churros were down.
That's right, yeah. Churro sales fell about 13%. But that was mainly because a big limited time offer, an LTO, at a major fast food chain wound down.
Okay. So temporary.
Seems like it. Management sounded pretty positive, actually. They mentioned a potential permanent spot on the menu at that same big QSR chain, maybe early calendar 2026. And the test for that, apparently going better than anticipated.
Oh, wow. Okay, that would be huge if that converts to a permanent listing. Definitely something to watch. And Dippin Dots, that seemed like another bright spot.
Yeah, Dippin Dots just keeps growing, mostly driven by getting into more theaters. They mentioned a new flagship customer at Urban Air, too. And even retail sales are picking up about $2.5 million in the quarter. New flavors coming next year, too.
That really shows the channel diversification paying off. But, okay, food service and Dippin Dots look good. Retail, though, that was down, right? 7.1% decrease.
Yeah, retail was tougher, pulled down mainly by lower sales and frozen novelties and handhelds. Frozen novelties were partly down because they did less promoting, and they were comparing against a really strong quarter last year.
Right. Tough comps.
But even there, like you mentioned with resilience, Dogsters and the Dippin' Dot sundaes, they still grew. And year to date, retail frozen novelties are actually up 3%.
Okay, so some pockets of strength. But handhelds were the big drag in retail, down 21%. What was that about?
Yeah, that was a direct hit from the plant fire last year. They just didn't have the capacity to make enough product after that happened. Big constraint.
Ah, the fire impact.
Yeah.
Still lingering then.
Exactly. But this is where management is, as you put it earlier, threading the needle, cleaning up the past, building for the future. They confirmed they've now shifted production to another existing facility.
Okay.
And this facility can apparently make more than they need. They expect to be fully back online capacity-wise by the end of this year.
And what does that mean for sales?
Well, they project it could add a 10% to 20% lift to handheld sales in 2026. So basically removing that big drag on the segment. It's a really important recovery story playing out.
That's huge. Great news for handhelds. And didn't soft pretzels in retail also do okay?
Yeah, they did. Retail soft pretzel sales were up 3.3%. Actually did better than the overall frozen snack category. Seems like the updated super pretzel recipe and packaging are working. And they're rolling that out to food service now, too.
Good momentum there. What about frozen beverages?
Up 6.1%, mostly driven by selling more machines, actually. Beverage volume itself was down a bit, but a big chunk of that was foreign exchange rates hurting them, like a 4 percentage point headwind on beverage sales.
Ouch. FX impact.
Yeah. But theater volumes bounced back nicely, again, thanks partly to Minecraft, although management did warn that they expect Q4 box office overall to be down compared to last year, so, something to keep an eye on.
Right. Okay, so beyond the numbers for each segment, the call also seemed to touch on bigger strategic moves. What did you pick up on the innovation side, especially with, changing consumer tastes?
Yeah, this is where it gets really interesting, I think. Beyond just refreshing Super Pretzel, they're launching new filled pretzels and bites for retail. But the big push seems to be on better for you.
Like what?
Well, things like high-protein pretzels, whole grain options, and clean label frozen novelties focusing on things like hydration, immunity, digestive benefits. They're even ahead of schedule taking red dye out of IC products.
Oh, interesting.
And they plan to remove all those certified food, drug, cosmetic colors from school products by fall 2026. So it's not just minor tweaks. It feels like a real shift towards health-conscious consumers.
Seems like they're trying to skate to where the puck is going, so to speak. Any news on partnerships or operational stuff?
Definitely. There's a major QSR. They didn't name names actively testing their IC products. Apparently it's going well and the test has been expanded. That could be another big win if it rolls out.
Another potential QSR catalyst, then.
Right. And operationally, they announced this big transformation program. Sounds like it's aimed at cutting costs across the board, finding efficiencies, modernizing finance systems, even optimizing their whole production network.
So more than just trimming fat, a deeper overhaul.
That's how it sounded. Which, for you listening, could mean more sustainable profits down the road, maybe making them more adaptable than competitors who are just chasing sales growth.
Right, that makes sense. Okay, speaking of discipline, let's talk financials and outlook. How are they handling inflation? That's hitting everyone.
They said their pricing actions have successfully offset ingredient inflation, at least the non-tariff kind, specifically called out chocolate, which has been a big headache for lots of food companies. So good cost control there. The quarter also had that non-recurring $10.6 million insurance gain from the fire last year. But they specifically said they used that money to speed up the handheld capacity rebuild.
Smart. Using a one-off gain to fix a core problem.
Exactly. There was also a small $1.5 million brand impairment charge, but both those things were taken out of the adjusted numbers, so you get a clearer view of the core business.
Got it. And just general spending, were they keeping a lid on costs?
Very much so. Operating expenses, if you exclude those non-recurring items, were up less than 1%. That really shows cost discipline, savings in transport. They mentioned getting out of some third-party logistics facilities helped too. They're managing the bottom line very tightly.
Okay. And looking ahead, Q4.
They sounded cautious, yeah. Pointing to the general consumer mood, potential tariff risks could be up to $8 million a year at current rates, which isn't nothing, and that expected dip in box office traffic.
So some headwinds still.
Definitely. But they also signaled that pricing and getting people to buy higher margin products should continue to help. And they've got new product launches planned for fiscal 26. So maybe cautious near term, but more optimistic longer term.
It really does sound like they're threading the needle, as you said.
Yeah.
Cleaning up the fire impact while pushing forward with innovation. That insurance money, even though it's a one-off, letting them fix the handheld capacity faster, that's a big deal. removes a, what, 7 percentage point headwind by early next fiscal year?
Yeah, it's smart capital use, not just a lucky break. And you see them shifting spending too, right? Away from maybe lower return promotions towards the stuff that makes more money, like Dippin Dots or those Bavarian pretzels.
Right.
And that shows up in that huge 21% jump in GAAP operating income on just 3% sales growth. That's focusing on profit per item, not just volume for volume's sake.
Exactly. And that innovation pipeline, the better for you stuff, the QSR tests, it kind of positions them maybe to do better than other packaged food companies struggling with inflation and getting consumers to pay more. Plus, having diverse channels like theaters and convenience stores helps buffer them compared to companies just relying on grocery shelves.
It gives them different levers to pull.
So for you listening, what are the key things to watch going forward?
Well, can they keep these margin gains going once that insurance money is fully lapped? That's one. What happens with churro volumes now that the big LTO is over? That's two. And how much does box office traffic really impact them, especially given the Q4 caution? That's three. If they navigate those well, it really proves this new cost discipline is embedded.
Okay. And the specific catalyst to look out for?
You've got the handheld line restarting. That's Q1 fiscal 26. Then the big FY 26 outlook they'll give at the Investor Day in November. Maybe some resolution on sugar tariffs. That'd be a plus. And maybe they do some small acquisitions, bolt-ons, and frozen novelties. Always a possibility.
Right. And valuation-wise?
Well, the stops lagged the consumer staples sector, the XLP ETF, over the past year. But if they can really deliver double-digit earnings growth like the plan seems to suggest, well, stock could get re-rated. It's trading around 23 times forward earnings now, which is actually quite a bit below its 5-year average. So there's potentially room for the valuation multiple to expand if the story holds.
Okay, interesting valuation point. All right, let's shift gears slightly. We always like to end with a bit of a, let's call it provocative play. You know, the kind of bold, maybe slightly out there idea you might hear kicked around at a hedge fund. Not advice, obviously, just a thought exercise.
Okay, yeah. Given everything we've discussed, the solid Q3 beat, the clear catalysts coming up, the stock lagging despite improvements, here's a potential angle to consider.
How about thinking about a long position in JJSF, but using out-of-the-money call options, maybe looking out towards mid-2026 for expiration?
The thinking there is, well, management has laid out this pretty clear path. Fix capacity, innovate, cut costs. You have the handheld restart in Q1 26, the Investor Day outlook, potentially new big QSR deals. These are all potential triggers, right?
Multiple shots on goal.
Right. And if those hit, combined with the stock trading below its historical average valuation, well, options could offer significant leverage if the market starts believing in the turnaround and the strategy shift.
So essentially, it's a bet that the operational improvements and the new products lead to that re-rating we talked about for a stock that maybe got punished a bit too much.
Exactly. A bet on execution translating into multiple expansion. Again, just a thought experiment.
Okay, so wrapping it all up. J&J Snack Foods. Strong Q3, beating expectations. Driven by solid financials, some smart strategic moves on innovation, and pretty disciplined operations.
Yeah, despite the cautious macro talk and things like tariffs, their focus on better for you, diverse channels, and efficiency really seems to set them up for continued growth.
And those upcoming catalysts, handhelds coming back online, Investor Day, QSR, potential, but definitely things to keep on your radar.
Absolutely. And just the standard reminder, this was all for informational purposes, definitely not financial advice. Always do your own research.
We'd love to hear what you thought, though. What stood out to you from the call? Let us know. Thanks for tuning in to TalkTickers.
Yeah, thanks everyone. We'll catch you on the next deep dive.